is my absolute pleasure to welcome you to the 15th edition of the 2021 Wealth Report. Against the sober backdrop of the COVID pandemic, we are thrilled that you could join us today for the global launch of our flagship publication. You are all extremely welcome. Last year, we presented the report directly to clients in over 30 countries around the world. Today, I'm talking to you from the rooftop of Winston Churchill's old War Office on Whitehall, which is currently being transformed into the OWO, with a 5-star Raffles London hotel, 9 restaurants and bars, and 85 branded residences. Today's launch is global, virtual, and only 30 minutes long, and relevant for any client with an interest in real estate. Please do go full screen to enjoy the full benefit of the presentation. Over the next 30 minutes, we will lay out the key themes and highlights of the Wealth Report, presenting our insight on private wealth, its impact on property markets, and then the evolving trends and opportunities that undoubtedly lie ahead in real estate and beyond. We will chart the past and look optimistically to the future, to the post-pandemic world, outlining where we see investors looking for outperformance, including from tech and innovation. A future, therefore, in my opinion, full of opportunity. As you would expect, the report is packed with thought-provoking content that is so relevant in our role advising and transacting with clients across prime property markets, both residential and commercial. My key takeaways this year are as follows. Firstly, real estate remains immensely attractive to private clients globally. Notwithstanding the economic uncertainty and global pandemic, the love affair with property continues. Let's not forget our clients have, on average, almost a third of their net wealth in real estate, from homes, lifestyle assets to investments. Even more important, therefore, to be well informed. Secondly, and crucially for the property market, global wealth creation has shown resilience. As you will shortly see, there are now over 500,000 ultra-high net worths globally. Let's see where this wealth is being created. From the US, today's dominant wealth hub, through to Asia, which is the growth powerhouse and already home to 36% of the world's billionaires. We will look at private wealth's attitude to investment and risk in these uncertain times. Some of the long-term trends that we examined last year have been supercharged by the pandemic. Behavioural shifts we expected to play out over the next 5 to 10 years happened in a matter of months. In this rapidly evolving marketplace, therefore, we believe your advisors in property should be well-informed, well-connected and straight-talking. I very much hope the next 30 minutes is testament to that. If you would like to discuss your property assets or requirements, we are of course on hand to assist. In the interim, however, I will now hand over to the esteemed Liam Bailey and the Wealth Report team to lead us through this year's findings.
In the middle of a global pandemic and an economic crisis, why should we be interested in the wealthy? Well, if we want to understand property markets and asset performance, then the wealthy form a critical part of the story. And the reason for this is that private wealth has become a dominant force driving real estate markets across the world. And as this year's report confirms, almost a third of global property investment is driven by private wealth. And while the institutional investor retreated over the past year, private investors grew their market share. The report confirms how the fortunes of the wealthy are changing. It provides an understanding of their attitudes to risk, identifies what they're investing in, and most importantly, explains what they're set to do next. This year's results reveal a fascinating story. Our data confirms that the global policy response to the pandemic supported the wealthy. Lower interest rates and ever more fiscal stimulus helped to push asset prices higher, and in turn increased the world's ultra-high net worth population by 12,000 people to over 520,000 individuals. The process was seen across North America and Europe, but it was Asia, with 12% growth, that saw the real upswing. And this continues to be one of our key wealth stories, Asia's relentless growth. Yes, the US is and will remain the world's dominant wealth hub over our forecast period, but Asia will see the fastest growth in ultra-high net worth individuals over the next 5 years, 39% growth compared to the 27% global average. By 2025, Asia will host nearly a quarter of all ultra-high net worth individuals, up from 17% a decade earlier. The region is already home to more billionaires than any other. And it is China, which is the key to this trend, with 246% forecast growth in wealthy residents in the decade to 2025. While the COVID pandemic is viewed as the biggest single risk to future wealth creation, nearly half of our survey respondents cite the growth in wealth inequality as creating a significant risk. With new wealth taxes and similar measures in Argentina, Canada, and South Korea likely to be replicated elsewhere around the world. In addition, the world is unavoidably going to become less global in the near term, with 84% of our survey respondents expecting to continue to travel less this year, with huge implications for themes from investment to international education. Despite a reduced desire for travel, nearly a quarter of ultra-high net worth individuals are currently planning to apply for a second passport or citizenship, a remarkable 50% growth in a year. While the pandemic has undermined globalization, more critically, it's also placed a question mark over the strengths of cities, certainly here in Europe, but also in North America. Rolling lockdowns have limited access to small urban pleasures. Neighborhood restaurants, galleries and theaters have been shuttered. The future seems to point to the suburbs and even beyond, but as urban guru, Professor Saskia Sassen, explains in our report, history shows us that cities rise, fall, but always rise again. Let's hear more on this critical question from Flora Harley, our deputy editor.
New York City is dead forever. This was one of the headlines being touted as the pandemic ravaged some of the world's leading cities, which appeared to spur a mass exodus. For the real estate sector, how cities navigate the pandemic is absolutely critical and is a key focus in the Wealth Report. However, as we confirm, the exodus was just temporary. Residents fleeing for greener pastures and more space is a notable trend, but our survey results also showed that 2/3 of ultra-high net worths were either more interested or saw no change in their desire for urban areas. Cities are far from dead. They are vital for innovation, knowledge sharing, and wealth creation. To help understand how cities are performing, our annual City Wealth Index uses a number of measures to rank 100 cities globally. We highlight those in which ultra-high net worths prefer to live, invest, and spend time. This year, in the unprecedented fashion which has dictated the past 12 months, we had a tie for the first time, with London and New York inseparable at the top. New York is home to the highest number of ultra-high net worths, with more than 7,700. Yet London has more millionaires, with over 874,000. On the investment side, New York has more global firms headquartered there and strong appetite for real estate from domestic private investors. However, London's global appeal drew in the most diverse range of private investors into the city's real estate and saw the highest cross-border level, with $4 billion invested in the year to September 2020. The UK capital also leads for lifestyle factors such as leading universities. To understand future prosperity, we also look at well-being and innovation across cities, with this broader view seeing some strong results from locations such as Munich, Edinburgh, and Seoul. We believe that rather than challenge, the pandemic has created opportunities for cities to evolve into something better. In the report, we spoke to Professor Sassen about how history shows cities rise, fall, and rise again. One of the biggest opportunities here is well-being and sustainability. With cities responsible for an estimated 70% of global carbon emissions, they are primed to lead the way to a more sustainable future. The 15-minute city, placemaking, green cities, all of these concepts are gaining more traction, linking to the drive for a green recovery and to improve the health of citizens, which is more prominent than ever. An example of where this is already happening is Barcelona. Home to over 700 ultra-high net worths, the city has placed sustainability at the fore with the introduction of superblocks in 2016 and the Climate Action Plan in 2018. These credentials, along with its 700-year-old cuisine and the unique ability to arrive in the city by super yacht, are drawing a new wave of investment and ultra-high net worth interest. With urban centres having quickly adapted to the pandemic, it demonstrates the vast opportunity to take it further. Cities will continually advance and thrive in a post-pandemic era, becoming even more attractive places to live, to work, and to invest. Now back to Liam.
Thank you, Flora. The centrepiece of the Wealth Report is our focus on how wealth creation and investor attitudes feed into property performance. As Kate Everett-Allen, Knight Frank's Head of International Research, confirms in this year's report, the world's prime residential markets actually thrive because of COVID and not despite it. Over to Kate for more.
Prime residential markets across the world displayed a surprising degree of resilience in 2020. The pandemic led to stronger, not weaker demand in many prime markets. Our Prime International Residential Index, which benchmarks luxury residential prices across 100 locations, both cities and second home markets, provides us with a really unique perspective as to how and where wealth is influencing property markets. In 2020, some 2/3 of the markets that we track registered price growth. And on average, prices increased by 1.9%. That may not sound much, but it's above what we saw in 2019. Low mortgage rates, more fiscal stimulus measures, strong performing equity markets, changing commuting patterns, and property tax breaks in some markets pushed demand and, as a result, prices higher. The markets that responded decisively to the pandemic and saw their economies reopen in 2020 are among the top performers. Auckland leads the index, with prime prices up 18% in 2020, followed by a number of Asian cities. Several North American markets also performed strongly. The standout trend in 2020 was the search for space, as the pandemic shone a spotlight on our homes and how we live. From Tuscany to Tasmania, with the global workforce no longer tethered to offices, people craved a base that could deliver all the things that lockdowns halted. Fresh air, space, views, and exploration. But with travel bans in place, demand in most markets was domestic in nature. Many of the second home purchases that we saw in 2020 will turn out to be what we're calling co-primary residences, and the expectations on them will be that much higher. This is just one of the 10 trends that we identify as having shaped property markets in 2020. Then there's the push and pull. Some policymakers are going out of their way to court this new globally mobile workforce, from 12-month welcome visas in Barbados and Dubai to more residency by investment programs. But not all governments are welcoming overseas buyers with open arms. As our attitude survey reveals, the growth in wealth inequality will see calls for more foreign buyer restrictions, as well as cooling measures and wealth taxes. Our Next Neighbourhoods article highlights almost 50 locations that we're tipping for growth, from hotspots for new digital nomads to those markets displaying greater resilience, and of course, those that deliver on space and the great outdoors. But what lies ahead? The pandemic-induced residential mini-boom will continue through 2021. Not surprising, given that 26% of ultra-high net worth individuals tell us they're planning to buy a new home in the next 12 months. Seoul leads our 25-city forecast for 2021, with Asian markets again expected to perform strongly. For London, 2021 is set to be the year that annual price growth moves out of negative territory for the first time in 6 years. For investors and second home buyers alike, all eyes are now on the speed with which commercial air travel resumes and cross-border transactions can normalise. Although be prepared for several localised spikes in sales as pent-up demand is released and the world tentatively reopens for business. Back to you, Liam.
So a strong performance across our key global residential markets. One of the big issues we've focused on this year is how investment property has performed through the pandemic. We've tracked where private wealth has been directed, but most importantly, we've assessed how the COVID crisis has accelerated market trends, opening new opportunities for investors. Here's Anthony Duggan, our Head of Global Capital Markets Research, to tell us more.
The latest wealth report confirms that appetite for commercial real estate will continue to grow strongly into 2021, with a quarter of all ultra-high net worths planning to invest in real estate this year. This is up from an average of 20% over the last few years. The data shows that demand is rising amongst private investors based in every major region of the world. So where will this significant wave of capital invest? The Wealth Report points us to the key strategic themes that ultra-high net worths expect to drive performance this year. These include identifying new investment opportunities in a post-pandemic world, with 87% of respondents picking this theme. Second is tech disruption, with third place going to improving geopolitics. So with this framing, where do we see private investors positioning for performance in 2021? Our first conviction theme is safe havens. Large, liquid, transparent markets with favourable financing structures and legal systems will continue to be a big draw for investors across all capital types. For private investors, they mean secure, strong income returns in the global low interest rate environment. The super cities will remain the key picks, and increased political certainty in regions such as the US and Europe will add further momentum to these core markets. Our second conviction theme is ESG. Our attitude survey clearly shows the rapidly growing interest in ESG. Nearly half of all family offices are now more interested in ESG-focused investments than they were 12 months ago. And for all ultra-high net worths, this rises to as much as 65% for North America, 60% in Australasia, and 51% in the UK. The pandemic has absolutely accelerated rather than dampened this critical theme. We believe that private investors can be at the forefront of capturing the green premium we expect to see for the limited number of assets that conform to the fast accelerating institutional requirement for sustainable real estate. As demand for these assets rises rapidly, the premium will emerge. Buying best in class or transforming brown stock will be a super hot topic this year. And our third theme is pandemic premiums. The pandemic has seen the emergence of a K-shaped recovery. Accelerated tech adoption and new ways of living and working have supercharged some sectors while shrinking others. Areas such as pharmaceuticals, e-commerce, tech manufacturing, renewables, digital entertainment and data storage have surged. Real estate sectors such as data centres, logistics, film studios and life sciences will continue to benefit from these trends and will see strong occupier and investor demand. So, for 2021, we believe that ultra-high net worths will be competitive, active and even more sophisticated buyers this year, looking to build diversified portfolios and also to seek out assets that reflect the post-pandemic performance opportunities that have emerged. Over to Liam.
A key component of the Wealth Report is our ability to take a wide view of the wealth portfolio. Over recent years, Andrew Shirley, the report's editor, has developed a unique index which not only tracks the performance of luxury collectibles, but as Andrew will explain, also confirms how the search for returns in a low inflation world is leading to a growing demand for tangible assets.
Looking for something unusual? How about a complete T-Rex skeleton for $31 million? Something shinier? What about this 16-carat purple-pink diamond for $27 million? You prefer reading? Maybe a first edition of Shakespeare's collected works for $10 million. Sports more your thing? Try out this pair of Michael Jordan's basketball sneakers for almost $500,000. Or you just need a new handbag. This Hermes crocodile skin Kelly for a mere $440,000 could be right up your street. These record-breaking sales are just a snapshot of some of the auction results of 2020 that show that COVID-19 and its impact on live auctions hasn't dented the enthusiasm of those who collect what we term luxury investments or investments of passion. And they reveal just how eclectic 21st century collections are becoming, not to mention how much their owners are prepared to invest in them. As part of the Wealth Report's mission to help its readers keep track of the trends beyond their property portfolios, about 10 years ago, we created our own unique luxury investment index. This tracks the performance of 10 investments of passion, although sadly, before you ask, not sneakers or dinosaurs, just yet. But we do have an Hermes handbag index, and for the second year running, it has topped our rankings with annual growth of 17%. With a strong collecting base in Asia, already used to buying via online auctions, the pandemic seemed to have little impact on this sector. Wine, easily traded online, and the classic car sector the antithesis of lockdown, and where many of the big deals are done privately anyway, also performed relatively strongly. Whiskey, however, took a rare step backwards as buyers shied away from the most expensive bottles. But it was the top end of the art market, most reliant on high-profile auction sales, that experienced the biggest COVID hit. With average prices down 11% in 2020, sales volumes of the major auction houses fell significantly. And last year, for the first time in a while, no work sold for over $100 million. But that's not to say collectors weren't buying art or that the auctioneers took it lying down. As the year progressed, buyers became more relaxed about bidding many millions of dollars for works of art they hadn't seen, even via apps on their smartphones. Auction houses innovated and galleries prospered. Sales became less about single genres and more about themed collections of objects and statement pieces that would appeal to lockdown collectors looking to brighten up their homes. A new breed of bright young artists like Ayaku Rakaku and Matthew Wong, the so-called red chips, created waves, especially in Asia. Collectors are being driven as much by what they see on their social media feeds as established conventions or reputations. COVID-19 has shaken up the world of art, introduced much-needed innovations to the sales process, and ushered in a new era of young, enthusiastic collectors.
Hello, I'm Tim Hyatt, the head of the UK residential business at Knight Frank, and I'm delighted to have the responsibility of concluding today's proceedings with 3 thank yous. Firstly, my thanks to all of our speakers for offering a first glimpse into this year's Wealth Report. However, it was just a glimpse, and we hope just the start of our journey with the report. The report itself is now live. Be sure to download your copy and explore the extensive content and insights available online. If you would like a more immediate response to any questions that you have, Rory, the private office, and all of our teams are on hand to discuss your next steps as you plan the year ahead. So please do contact them and see how we can help you. While we are still living through unprecedented times, our teams in the UK and around the world are open for business, abiding by relevant COVID regulations, but here to support you, whatever your property requirements might be. I would also like to take this opportunity to thank the Knight Frank Global Business for supporting and contributing to the creation of the Wealth Report. This publication is truly a demonstration of the breadth and reach of Knight Frank's network and our unique strength across both commercial and residential markets, as well as the hard work our marketing and research teams across the world. The report wouldn't be possible without all of us collaborating together. Finally, I'd like to thank you on behalf of Knight Frank for your continued support. This year marks the 125th anniversary of Knight Frank, a milestone which is testament, I believe, to the partnerships that have been created over the years between our teams and you, our clients. Thank you.